everyone. I am delighted to be here today to open this session jointly hosted by the International Monetary Fund and Georgetown University to launch Chapter 3 of the IMF's 2022 Global Financial Stability Report. The topic at hand today, and covered in depth in that chapter, is what the implications of the rapid growth of fintech are for financial stability. And we plan to cover everything from decentralized finance to super apps and the various risks these new technologies might pose to global financial systems. I'm delighted to be joined to discuss these ideas live and in person by Antonio Garcia Pascual, who is Deputy Division Chief at the IMF and the lead author of Chapter 3. Welcome, Antonio.
Thank you.
I'm also joined in the studio by Chris Brummer, who is a law professor at Georgetown University and the founder of DC's Fintech Week. Welcome, Chris.
Thank you.
I'm no less delighted to be joined virtually from Argentina by Horacio Liendo, who is the Senior Legal Fintech Director at Mercado Libre, the South American online marketplace and financial services company. Welcome, Horacio. And lastly,
Hi, thanks.
And lastly, but certainly not least, from California by Lily Francus, a senior financial analyst at Moody's, the credit rating agencies, who is an expert in building all kinds of financial models which quantify risks in financial markets, including various DeFi models. Welcome, Lily. My name is Alice Fulwood. I am the Economist's Wall Street correspondent. So, to get started with our exciting event today, I would like to first turn to Antonio, who penned the third chapter of the IMF's Global Financial Stability Report, to take us through some of the key conclusions of that chapter. What do you think are the most important findings or conclusions from the chapter you've just published?
Thank you, Alice. So, yes, this is one of the analytical chapters of the Global Financial Stability Report. So, this chapter focuses on the risk and the vulnerabilities of the rapid growth of the fintech sector. Obviously, it brings a lot of opportunities. Fintech, it helps reduce costs, it increases efficiency, it broadens the access, but also all of that comes with risk as it's been growing really fast and sometimes regulation has been lagging behind. So in this chapter, we look at three important case studies. First, we look into the case of the digital banking, the neobanks. This was truly a deep dive into the sector. We look into across 18 countries, large number of neobanks and traditional banks and compare them. And what we found is that these institutions are taking basically riskier clients and riskier loans. They tend to under-provision and underprice some of the credit risks, and they tend to take sort of higher liquidity risks. Okay, so that puts a little bit of pressure on the regulatory side that we will discuss a little bit later. Now, we also look into a second group of fintech, which is the fintech in the US market. This is actually where fintechs have been playing an important role for a long time. It's a level playing field. And what we find is that the fintechs actually exert a lot of pressure on the traditional banks, a lot of downward pressure on the profitability. But what we also find is that those banks that actually invest more, that are more tech-like, like the fintechs, they actually, the profits are stronger. So clearly investment in technology pays off for those institutions. Thirdly, we also look into the exciting topic of decentralized finance, which is really at the frontier of sort of deposit-taking lending. As you know, this is a system that operates over the crypto ecosystem. It is fully decentralized and it operates over a computer network. Now, it does bring efficiencies. It's truly innovative, but it also comes with risks. Importantly, anonymity, right? That is an issue that makes regulation very difficult and creates problems in terms of risk, like for AML and CFT. It also, the liquidity and lending platforms have important market, credit, liquidity, and cyber risks. Let me give you two examples, and I conclude with this. So on the cyber risk, for example, what we find is that every time there is a hack or a cyber incident, what we find is that 30% of deposit in some of these liquidity platforms are lost. And in some cases, the whole platform has to shut down, okay? Obviously, this is an issue. Remember, in DeFi, there is no such a thing as sort of deposit insurance. And the second one, which is very interesting, you will think that in decentralized finance, concentration is less of an issue. It's not an issue, right? It's decentralized. You would think that sort of the risks are sort of not so concentrated. But the reality is that depositors are highly concentrated. So what you have is that in some of these liquidity platforms, less than 10% of depositors account for over 50% of the liquidity. So you can imagine if one of those few depositors pull out, the liquidity platform in some cases may need to sort of shut down and create spillovers for the others. But let me pause here.
That was very comprehensive, a lot to sort of take in there. I think I'll come to Chris in the studio first. And, you know, there's a huge amount that Antonio is highlighting here, the sort of pressure that new entrants are putting on banks, the potential higher risk that fintechs are taking, and this sort of new exciting world of DeFi, which comes with sort of all sorts of potential upsides and downsides. I guess as someone who, you know, has to advise policymakers or think about how to regulate these things, which of those areas seems sort of most pressing to you? What is most likely to keep you up at night?
Yeah, I think I just maybe start by just thinking a little bit about this term fintech, you know, and I want to applaud the IMF for really, and Antonio for taking this big swing at a very diverse array of actors and trying to think across very different ecosystems to find common points of threats and pressures to develop, you know, a 10,000-foot sort of overview of financial risk, and then to think in a second step about what the policy responses in the toolbox could or should look like. You know, as a law professor, you tend to just, number one, look at where failures have happened before in the past, and then you ask yourself, well, you know, are any of those failures replicable in today's ecosystem? And for sure, a lot of our attention is focused on what happened in 2008. And you look at, you know, shadow banking as it's described, and you ask yourself these very serious questions about whether or not any of those risks are replicating themselves, but in a different guise. I think that that being said, ultimately, fintech is nothing more than the latest chapter in the digitalization of the economy, right? And so you do have to try to disaggregate, you know, number one, after defining and thinking through what is fintech, you know, is digitalization, is frankly being connected to the internet, creating risks that are specific to financial technology, to novel financial technologies, or are these risks that are more generic and more pertinent to even large financial institutions? And many of the risks that are in that report are really risks I think regulators are looking at throughout the financial ecosystem. But if I was going to really put my thumb on one issue that keeps me up at night, I think it's cyber risk. You know, the idea that, you know, you can get all kinds of efficiencies, all kinds of opportunities to diminish risk potentially if done well by implementing different kinds of technology like machine learning and AI. The fact that you can leverage peer-to-peer transactions on a blockchain, and like you're always thinking in the back of your mind, whatever the financial technology being employed and in whatever vehicle that financial technology is ultimately being employed, you know, what are those cyber risks? And those cyber risks are not going to be merely addressed because there may be some kind of deposit insurance regime. You know, there are many kinds of risks that can arise in the cyber context that impact traditional finance as much as you know, some of these more newfangled technologies that people have to think through seriously because they can compromise not just money but also data. And when you get into that conversation, I think that's increasingly, you know, that this idea of data compromise is increasingly becoming a really important source of risk, not just to privacy, but also to financial stability and security.
Horacio, I'd like to come to you next on this, because you're sort of right in the belly of one of the sort of biggest fintech success stories in South America. Could you give us a sense of what the upside of Mercado Libre's business model is, a little bit about how it works, and also how you think about some of the risks that Chris and Antonio have highlighted, whether that's cyber risk or you know, potential higher credit risks associated with the types of business that Mercado Libre might be doing.
Thanks, Alice. Thanks very much. It's a pleasure to be here sharing our experiences. The approach you described is very interesting. However, I think it's also interesting to see it from another point of view, which is the point of view of the excluded. The opportunity, it may be a good way to put it. It's also a business opportunity, is to approach the population that banks do not address. There's a public interest in this. Financial inclusion has been up in the agenda, in the public agenda for a long time now. And banks don't address such population for a number of reasons. There's not much information about them. They lack sometimes the capillarity to promote their services in an efficient way to the broader public. They don't have sometimes the technological infrastructure to scale that sort of business, and they are probably comfortable and profitable as they are. So they don't have an incentive to expand their financial services to a broader population. So the challenge is to approach the unattended in a profitable way and in a secure way. So the solution, as Chris was saying and Antonio said, is to use technology, to use state-of-the-art technology with data analysis, machine learning, AI, to find, onboard, communicate with, and get to know the excluded population that can be as secure and as trustworthy as bank clients. I read the report and they said that fintechs address riskier population, but that at the same time, the delinquency rates of credits granted by fintechs are similar or lower to the ones of banks. And I think that's the critical problem. The population that banks don't address is not necessarily riskier. The main problem is how we measure risk. If we use or keep using outdated hard models, if we treat people as numbers, we will most probably get it wrong. Fintechs have the ability to get to know the behavior of people in a very profound way. So in short, I think Antonio said just before, technology pays off. Technology provides a way to reduce costs, to reach further into the public, and to better assess risk. So I think we should embrace it because it helps lots of people every day.
I'm certain there is a ton there that people want to come back to. I might go to Lily first, then Chris, I'll come back to you on some of what Horacio was saying. Lily, I wanted to ask you about how you in your work at Moody sort of help quantify some of these risks that people are talking about. I know you've looked at sort of DeFi risks as well as some other financial risks. So why don't you just talk us a little bit? People like Horacio talking about some of the huge benefits that you can get from serving different populations, the potential efficiency gains from DeFi. It seems very difficult to then quantify how big the problems might be. What is your take?
Yeah, so I mean, I would say DeFi is like the complete other side of the continuum with knowing your customer versus completely not knowing your customer. I think that's, fundamentally a barrier for further adoption, especially if you look at these industrialized markets or even, some types of emerging markets where essentially you can get these efficiency gains and you can give out riskier loans, at least by traditional financial metrics, by knowing your customer at a deeper level than what is usually considered by normal banking standards. But I think obviously in DeFi, because it's trustless, you don't know who's taking a loan. So to this point, we've mostly seen the proliferation of over-collateralized loaning, since fundamentally, there is no way to differentiate a good actor from a bad actor on the blockchain. At Moody Analytics, I'm currently looking at understanding better the risks of DeFi. I think fundamentally from a regulatory perspective, there's not only the consumer aspect of it in the sense of how do you protect consumers between these highly technically specialized platforms, because there's good actors, there's also bad actors, but also how do you think about the linkages between traditional finance and decentralized finance? Because I think fundamentally there's a lot of major companies that do not have first order, relationships to these platforms. But when you think about your counterparties, are they doing business with the blockchain? Are they, interacting with a MakerDAO or Maple Finance or one of these, newer decentralized financial protocols? And I think it's, interesting from a consumer perspective, especially because in DeFi, traditionally the lender and the borrower are the same person. And what you can see is, since there's no opportunity for recourse, the cyber risk, as Chris was mentioning, is super damaging to these protocols, not only from an individual level in the sense of losing your money, but in general, as your report stated, you're seeing that 30 to 100% losses in some of these cases, especially in the most well-known of hacks. I mean, recently there was a protocol that lost essentially $600 million, which is an obscene amount of money. And I think it gets back to the root of the question that a lot of these are very technologically advanced protocol designs with a lot of inbuilt financialization. So fundamentally, your code may be audited, it may be bug-free, but you may depend on a library that has some bug that nobody was aware of. In which case, as a consumer, especially as someone who's looking at these protocols, you don't have the fixed recourse systems you would have even with a traditional fintech. So how do you go about selecting a safe protocol for basically for your own usage?
It's really remarkable listening to the sort of range of issues we've already discussed in the first sort of 15 minutes of this panel. It really is a fascinating time to be thinking about financial innovation. And I do want to give our in-studio panelists a chance to come back to some of the comments that Horacio and Lily have made. Chris, can I come to you first? I know you're sort of interested in talking about the risk profiles of different kinds of borrowers. Perhaps if we try to stifle innovation in any way because we're worried about risks, you might lose out on some of the benefits that people are discussing. So what do you make of that idea?
Yeah, I just wanted to say that the conversation in Brazil is frankly very similar to the conversation that we're having in the United States. Trying to figure out where does financial technology fit and to what degree does it open up opportunities and open up the credit box? And are there ways to open up the credit box in ways that actually end up reducing risk while extending opportunities for people who have been historically underserved and who have historically not had access to core financial services? And I think that's a really interesting question. It's an interesting and important question in part because most financial regulatory agencies in the United States, don't necessarily have as part of their mandate, financial inclusion. And so even when you're going about and depending on data and thinking through the data that's generated by even U.S. regulatory bodies, it's useful to just sort of keep in mind that that's not formally part of what they do, right? And so when you think through financial technology firms, when you think about the market that they are trying to address, and then when you think about sort of traditional legacy banks, and frankly, the fact that they haven't done so well, at least in the United States and in many other countries, in terms of addressing those historically underserved populations in their countries, the question of risk becomes very interesting. And again, when you deploy new kinds of technology, you have to first ask yourself, what do you mean when you talk about the risk profile? Just as one example, I'm on the board of Fannie Mae, one of the largest sort of backstops and lenders and market participants in the mortgage market here in the United States. And we introduced a credit scoring model that's based on rental data and not just do you own a home, right? And this idea that, well, most people don't want to lose their homes anyway. So if, does repayment history for rental purposes, does that not only unlock opportunities, but, does that create a very safe way of assessing risk? And, when you're looking at a fintech and you're looking at different kinds of credit models, different kinds of ways of looking at risk, I do think that you have to be very, very, very careful, not just, again, in looking at what the reward and what the upside is, but also making sure that we're not comparing apples to oranges when we're thinking about the question of risk.
Antonio, what do you make of that perspective? I guess you are tasked with trying to evaluate the risk in all these different kinds of technology, and the tools that you used to evaluate them 10 years ago, you may not sort of apply in the way that they once did. So how do you even approach that question when you're trying to put together something like your report?
It is a complex question because some of these technologies are new, as Chris was discussing, and Horacio. So when we look at sort of the main risk metrics with which we judge banks and neobanks, what we do see is that some of the newer ones, in order to get new clients, tend to go into younger clients, lower income clients. They need to sometimes go into riskier type of loans, non-collateralized. And that generally, what we've seen historically is those eventually bring higher expected losses. Now, we haven't seen those. That's the reality. We haven't seen those. It's been quite sort of interesting times as well, because we went through the pandemic. So that was a major shock. You would have thought if things would have gone wrong, they would have emerged there. But actually, there was a lot of policy support. So it was not the genuine, actually, shock either. So as we're hearing from the fintechs themselves, of course, the new technology means that perhaps they're better at measuring, managing risks. At the same time, we know they're into some what we call perhaps riskier borrowers, riskier loans. But the reality is that we haven't seen those losses. Okay, so I think perhaps a bit the jury's out in a way that yes, there's better technologies. There's no doubt about that. But the past 2 years, even though that it could have been a massive test, it was not because of the policies. So I think it's still fair to say that okay, potentially the losses may be there because these are riskier businesses, but they also have better technologies. So I think future, in a way, will say about this.
Horacio, I wanted to come to you on that idea. I mean, the Mercado Libre sort of payments and financial business has grown enormously over the past sort of 4 or 5 years. And do you feel like you've really experienced a shock, and therefore you feel that the business you've built, you think, is resilient to potentially some of the dynamics that have failed innovative financial businesses in previous crises? Or do you think that there's still quite a lot of uncertainty about that internally?
Well, thanks, Alice. It's a very good question. I was hearing carefully what Antonio was saying and what Chris was saying, and I agree with both of them. But I think the previous idea was that younger, lower income, non-collateralized customers are riskier clients, and I agree that that's the first impression one gets. But it also relates with the amount of the credit and the purpose of the credit and the behavior of that particular client in other aspects of his or her life. So I believe that, and in this coronavirus crisis that we had in Latin America, which didn't have as much help from the public sector as in the developed countries, we didn't find delinquency rates going up. Because I think the model was a good model and it was made and scaled very carefully. And in my opinion, the best way and the best strategy to regulate is always to align incentives. Because on the other hand, if incentives are wrong, most of the times regulation will most probably not be enough. Our experience in Latin America has been diverse, and some regulators, Chris pointed out the technology problems, the operational risk problem. I agree with him, and that's not a fintech problem. That's an industry problem, financial industry problem, and maybe it's broader than finance. And regarding the technology, and it should be carefully assessed. But some regulators have started to regulate financial products in so much detail that they end up endangering the user experience and the innovation. Regulators don't have the incentives to retain customers and have a high NPS, the Net Promoter Score. Their goal is to mitigate their perceived risks, which, as Antonio said, in the field of fintech, have not yet materialized, and they are not really concerned with user experience. On the other hand, fintechs have very good incentives. Of course, they want to avoid fraud and lend to clients that will repay their loans. No fintech wants to lose money, and they also want to have good conversion rates, good cross-sell, and excellent UX, high NPS. So they have the incentives to grow in a secure way. So to summarize, I think that good incentives are always the best way to regulate. And in the case of fintechs that are public companies, which also have the market looking at them with skin in the game in lending, have always good incentives to grow in a secure way.
Let's turn to that policy question now then. And, Horacio talked about aligning incentives as a good sort of principle for how to regulate financial services providers. Chris, what are some of the sort of first principles you would suggest regulators should think about with these sort of when regulating these new financial technologies?
Yeah, I just want to also pick up on what Antonio just mentioned, because I thought it was really interesting. And Horacio, I mean, really, the points of stress that you've seen in the pandemic is, you've seen stress in money market funds, You've seen certain stresses with family offices. You've seen certain kinds of stresses, frankly, in the U.S. Treasury market, right? And those, kinds of stresses, may be industry, operational, right? But when you think about this larger question of fintech and its growth, again, it's a little bit, interesting to say the very least, to sort of see, well, where are the risks developing? Are the best tools and risk analytic tools being deployed? And sometimes they may, and quite frankly, I agree that the jury is still out. But again, prudence is what's required, not just by the industry, but by the regulators as well. I think regulating innovation is really, really different. I wrote a paper about a trilemma, that ultimately, when you try to regulate innovation, you're faced with this challenge of providing clear rules, both for the industry and for regulators who are enforcing the rules, creating market integrity, and also enabling innovation. And when you look at the history of financial regulation globally, you can usually only get 2 of the 3 goals, between market integrity, clear rules, and innovation. And so part of the challenge as a principles-based of thinking through how do you regulate financial technology is to create a new toolbox for the regulators. Now, one of the first iterations of the toolboxes for regulators, as everyone probably watching is aware of, are these kinds of regulatory sandboxes. But increasingly, particularly when you get to things like DeFi and crypto, I think it would be very useful for people to start looking at crypto not just as, and some of this new kind of financial technology as not just a product, but as a technology. Because then when you start to think about, in this particular instance, DeFi, as a technology stack, then you can think about whether or not it's possible to create crypto-native compliance solutions that actually not only enable a better user experience, but actually further the mandates of the regulators in ways that, frankly, the legacy regulatory technology stack can't. And in the securities law world, I've talked about things like disclosure NFTs and disclosure DAOs, and whether or not certain kinds of innovations in the space can work better than regulatory databases that are hacked, right? But I do think that process of speeding and enhancing the ability of regulators to do their job will be understanding risk from an economic standpoint, but it's also going to entail some deeper understanding and appreciation of what the technology is, and a certain kind of courage to come up with solutions that lean on the opportunities presented by the technology while being very serious about whatever risk they identify.
Lily, I'd like to come to you on the ideas that Chris has just discussed. This, what is the best way to regulate DeFi? The conclusion of the report, of Chapter 3 of the report, is that, you should focus on regulating things like stablecoins, which tend to be sort of more traditional centralized entities as a central approach. Chris has talked about sort of approaching it like a technology. What is your perspective? How do you think we can best regulate DeFi?
So it's interesting. I mean, I think the way that I usually view it is you have crypto space and you have, let's call it fiat space, essentially. And you have these, passages and connection between the two. I think the touch points are, as you mentioned, stable coins, real world assets in general. You could almost consider stable coins as this synthetic, real world asset, this representation of the US dollar, and of course fiat on and off ramps. So I think there's fundamentally a lot of concern about AML KYC and the potential for, let's say, terrorist financing. This is something that, Moody's Analytics has looked into, especially as, this is kind of very auxiliary to our current solutions in those areas. But I do think, realistically, DeFi has this potential to not only, as people say, bank the unbanked, and you see this adoption in countries that are experiencing monetary instability like Nigeria, Turkey, Russia, and Ukraine. But fundamentally, I guess my optimism to it is more on the idea of efficient capital allocation. I think that, the instant settlement and cross-border applications are pretty unique versus traditional legacy systems. I think what Chris said, I completely agree with, and the idea that there is a lot that's the same in DeFi. There's fundamentally some major differences, even at a core level, like the understanding of custody or disclosures or what certain aspects we take for granted, even, personhood, what that means on a trustless, anonymous financial system. But I do think that from a regulatory perspective, there needs to be kind of this meeting of the minds with people in industry and the actual regulators themselves to devise some pretty logical and not too draconian measures to regulate the system, while also being understanding of the potential for systemic risk. Because I think fundamentally the issue is, crypto space may have high leverage, crypto space may have this unique financialization, but what people are fundamentally more concerned of is the connections between crypto space and the real world.
That's right.
I wanted to come to Antonio on that idea. It's, in particular, one of the things that sort of struck me when I read the chapter was you had this excellent sort of chart and analysis of how much more efficient DeFi appears to be than traditional finance. I think it was, the marginal cost of providing services in DeFi was like a third of traditional banks in advanced economies and a fifth of those in emerging markets. And as much as we focused on a lot of the risks associated with it, I've never seen that kind of analysis before, and I was kind of struck by how powerful it seems. So, I mean, do you think DeFi is the future if we can get any sort of handle on regulating it, or what do you make of that idea?
I think it's complex regulation. I mean, the points have been made. Anonymity, right? It operates through private keys. We don't know who the owner of the accounts are, right? That puts a tremendous complication for regulators. Then you have decentralization. You don't have a centralized governing body. So how do you go about regulation of that? So traditional regulation is not effective. That is clear. So that's why, as you mentioned, Alice, we propose as a first step to focus on the core elements of the crypto ecosystem, stable coins, crypto exchanges, or wallet service providers. But at the same time, I think, perhaps a second stage, you would also expect that for DeFi platforms to adopt more robust governance. And I guess this can be done through basically industry codes or establishing self-regulating organizations, as Lily was mentioning. This could be like traditional security markets. And then eventually these organizations could be the touch point, the conduit for an effective regulation. Now, to your first point, Alice, on deficiencies. Now, we've seen so far in the DeFi platforms that this is mainly institutional investors players. It's not individual players like you and I that participate mainly. It's mainly for institutional investors. And of course, once this regulatory framework or approaches are in place, you would expect that then, more participation, fees come down, and perhaps it becomes sort of the future of finance. But there's still a long way to go in which regulation, and in some cases, self-regulation, can play an important role.
I guess, thinking about the sort of DeFi issues, the sort of, as you say, the big role that it has for institutional investors, the sort of limited role it has for normal people to actually use it. It seems sort of a million miles away from what Mercado Libre is doing in Brazil. I guess just to come back to, there are almost these sort of two different theories of how finance might develop. DeFi is sort of coming in from the institutional side, this sort of much more efficient, very technical, automated system, and then you have companies like Mercado Libre who are coming in through sort of day-to-day interaction with sort of retail customers. Could you just talk a little bit about how you think that sort of approach is potentially sort of going to be the future of finance rather than DeFi, Horacio?
I don't have the answer. What I can tell you is what I've seen in Mercado Libre. Mercado Libre has a complete financial ecosystem. It started offering clients the ability to have a transactional account and a prepaid card, which are these e-money license, which are not bank licenses. It's sort of a narrow banking approach. So with that, it allowed people to do things they couldn't do before. Now they could pay online. They could use electronic means of payments in shops, and that grew a lot. The main countries we operate out of Brazil, Argentina, Mexico, and Chile, but we operate in 7 countries. And just to give you a quick number, by the end of last year, Mercado Pago, which is the financial branch of Mercado Libre, had 51.5 million active users. That means people that used either the card or the account to pay. And it grows from there. Merchants were offered the ability to collect payments and get credit. Then it grew to consumer loans and personal loans and the ability to make some very basic and secure investments and to purchase insurance. And now, even in Brazil, we have the ability through our digital wallet to buy, hold, and sell Bitcoin, Ethereum, and USDP. So what's the future of finance? Maybe it's a combination of both. From my point of view, what I see is that the broader public does not use private keys. They need someone to provide a very simple, easy to use and good product financial interface. And most of the time that includes intermediaries, and those intermediaries have to comply with all AML regulations and KYC. So probably I think what I'm getting at is to expand the financial products to the broader public and promote financial inclusion. Maybe anonymity is not such a big feature that the public is needing, and we can grow in a more organic way through this kind of financial services.
So I guess if we think about sort of all the things that we've covered in the final few minutes here, there are sort of all of these sort of fintech entrants into financial services. There's this nascent DeFi financial system, both of which offer an improvement on the sort of traditional financial system. DeFi perhaps more efficient, Mercado Libre sort of easy to use, offering services to customers in a sort of much more digital native and also a kind of efficient way. Is there still a role for traditional banks in these worlds, and how do you, I guess, sort of create a safe financial system that has the room for those kinds of ideas to flourish, while also all of the ways in which we've regulated traditional banks to keep them safe can still sort of bear fruit? I mean, that's, I guess, so the sort of broad question I guess I'd like to put to all of you in the final minutes. I'll come to Antonio first. What do you think? How do you get, I guess, the sort of best of all 3 of those worlds?
I guess you were asking for, I think, was Chris that talked about the principles. I think one principle we should keep in mind is sort of same risks, same business, same type of regulatory approach, so that you can set up a level playing field. And then, of course, I think there will be room for banks, for neobanks, for fintechs and DeFi to operate there. The way I say is, depending on the type of businesses, you could see that banks may have sort of a comparative advantage when you talk about corporate loans on M&A funding, where there is a lot of private information there and interaction with the client, where it'll be difficult to beat the banks, whereas you dealing with big data and managing of that data with these fintech technologies that Horacio was discussing and Chris, and then perhaps I do see what fintechs can do better in that space, as well as DeFi, organizing all this and arranging this public data. So I think there's a scope for all. Obviously, for banks to survive, as we saw clearly in the U.S. mortgage market case study, they need to shape up. They need to invest. And invest they're doing. You see the big institutions, the biggest spends and expenditure planning is actually on fintech, on technologies, right? Sometimes it's cooperating, sometimes acquiring them, sometimes it's organically. But that is clearly the name of the game for the progress and be able to stay in business.
Chris, do you agree? Banks can stay in business if they shape up?
Yeah, yeah. I mean, the really interesting thing, right? Particularly that we're asking even in the United States, we didn't talk about it here, is, we're talking about the threat to banks, if one will, or from these new technology players. But even in the United States, part of our debate is, well, what happens if our central banks start to become much more involved in banking in the form of a CBDC, and what happens to whether a repatriation of assets from banks to the Fed and the like, right? But I do think that generically, and the more actors who are in the market competing, facing the same risks, under the same regulatory regime, when you look at their business and their risks, and again, actually kicking the tires on what those risks are, which includes a real understanding of both the market and the technology. And then you impose, the appropriate regulatory regimes. I think you have to say that the competition has to be good. We've had in the United States, and I think globally, a real conversation about competition in financial services, who's being served, who's not being served. And I think that banks can shape up, but banks have not always been competitive, not just in terms of the operational capacity, but they haven't always been competitive in terms of, frankly, expanding the addressable market. And I think that what they're seeing from a lot of these players are folks with good ideas and sometimes better technology who understand that there's an ability to scale while also providing bespoke financial services, a kind of an irony in and of itself. But that's what's in effect being done, and I think that banks are going to have to invest in not just the technology, but really changing, an investment in changing their mindset about their business and about, frankly, folks that they haven't always taken it upon themselves to serve effectively. But they can absolutely shape up, and banks will always be critical, infrastructure for certainly the U.S. economy.
I'll go to the two panelists out the studios. I guess either to sort of come back to what Antonio or Chris have said, or on that sort of same idea. Lily, this sort of healthy DeFi being healthy competition for banks. What do you?
Yeah,
what do you
it's interesting. I mean, I guess being in the weeds with it, I see DeFi as primarily filling the role of private debt and somewhat private equity at this point, where, fundamentally when you view the market, credit is like the difference between your collateral value and the loan value. I think fundamentally with traditional recourse, we can have a credit system based on the fact that you can go to jail if you are fraudulent or have some basically inability to pay that isn't, something that's protected. And I think because of that, the issue with DeFi is, it's fairly insurmountable, barring some kind of technological advancement, to have a true, realistic, on-chain only credit system. Because fundamentally, anybody can create a new address. There's, there are ideas and systems about, trying to get it from a more theoretical approach. But I think right now DeFi fills the role more of private debt. And I do think that the future of it will be this kind of marriage with traditional finance, both with banks and neobanks. And essentially DeFi acts as this very efficient way to grab liquidity from actors who are looking for higher yields and who may have higher risk tolerances, and transform it into some kind of mechanism that they can work with traditional KYC and traditional neo or regular banks to provide that capital to these new markets. So I think that really DeFi's role in the future will be primarily for helping efficiently allocate capital rather than a full replacement of traditional banking.
And just lastly to Horacio for a final comment, if there's anything you'd like to add on that idea.
Yeah, going back to the question of banks, I think competition is good, and what financial inclusion needs is more investment, more innovation, and if banks are forced to shape up, that's good for everyone. And I think there's room for everyone. And as the addressable market expands, the banks will find the place in this new world. In Mercado Libre, we work with lots of banks, and they complement our business. And the synergy is great, and it's excellent, and it works for everyone. So my take on that is that, yes, banks need to shape up, technology is good, and competition will help everyone.
Thank you so much. I think we are just about out of time. It's been a sort of very sprawling discussion covering lots of different kinds of financial technologies. I'm going to steal an analogy that a central banker at the Bank of England used, but he described the world of finance that we live in now as essentially at a punctuated equilibrium, where there are all kinds of new emerging technologies and innovations, and you don't necessarily know precisely what survive, but the hope is that it will be a sort of more efficient and hopefully safer financial system than what we've worked with in the past. I'm very grateful to people like Antonio for taking on the sort of very difficult task of trying to quantify and analyze the risks in those new systems. And the third chapter of the Global Financial Stability Report is really excellent, and I recommend that everyone watching goes and immediately reads that. So thank you so much to all of my panelists for joining us today. Thank you for Georgetown and the IMF for hosting us. I hope you found the discussion fun and had a good time, even if it was a little broad. But thank you so much for your time.
Thank you.
Thank you.
Thank you.
Thanks a lot.